Good morning, everybody. Welcome to another Daily Market Report brought to you by Mike Bjork. Today is Thursday, and it's March 1st. Welcome to the first day of the month here. We got a lot of data to cover today, so we're just going to jump right into this. We'll start off with the weekly jobless claims. So last week we had 220,000 people apply for unemployment. Great number there. The forecast for this week was 226, and it dropped all the way to 210,000. This is the lowest number we've seen since 1969. This is how good the job market is becoming right now here. So great overall number there. Now let's touch on how people wages here. We got personal income for the month of January. So December went up 0.4%. Forecast it shows a 0.3% growth for January and went up 0.4%. Great numbers. Again, people are making more money in January, which is obviously a very good sign. Now, we also got consumer spending in the month of January. We had a 0.4% in December, which is obviously good because we had Christmas time. 0.3% forecast for January, and only went up 0.2%. So people are spending a little bit less money in January, probably trying to pay off the credit card bills that they accrued during the Christmas time holiday season here in December. Here's a big number we've been looking for, core inflation. Core inflation is part of the personal consumption expenditure. Now, this is the Fed's favorite gauge. So the headline number is a PCE, or personal consumption expenditure, but when they strip out food and energy, that gives us what they call the core inflation, because they can't control food or energy. So the volatility of that, they kind of strip it out and they give you the core inflation. So with that in mind, in December it went up 0.2%. Forecast is at 0.3%, and it came in at forecast at 0.3%. Now, the headline number came in at 1.7%, but the core inflation came in at 1.5%. The Fed's gauge stayed at, well, they both remained the same. So they were at 1.7 and 1.5 respectively, and they remained the same. So basically, the Fed's gauge, as you may have heard, is 2%. Their target rate is 2%. So we're still below that 2% rate here. But we are starting to see a little uptick in the wage inflation here, which we saw in personal income. That's starting to get a little bit bigger, and so we'll have to kind of see if that may, bump that up. And we're also starting to see bigger chunks now, like this 0.3%. I think December went up a little bit, so we'll have to kind of see if that also kind of gives us a little bit more higher inflation creeping up later on as well. So those are things we're going to watch out for. Now, the next two indexes are manufacturing. We have the market manufacturing for PMI. Anything above 50 is considered improving on these two indexes. So we had a 55.5, and it had a slight dip to 55.3. But on the other end, we have ISM manufacturing. It had a 59.1%, and the forecast was supposed to have that slight downturn, slight drop to 59, and it went up to 60.8. So that's the best number we've seen since May of 2004. So a great number right there as well. So manufacturing is showing some also good data here. And last but not least, we got construction spending. We had 0.8% back in December. Forecast was supposed to be 4.4%, and it came in very disappointing with basically nothing happening in January. Could be weather, could be, I'm not really sure what brought this about, but or maybe people are just trying to get last minute budgets for end of year in December. Maybe that's why we had such a big one in December, and then basically taking a break or dealing with different stuff. But we did have some pretty rough weather for, like, especially the Northeast and stuff here. All right, so let's just kind of continue this on here. Stock market is down. Stock market was up earlier in the day. It started up, but again, kind of like on Tuesday, we had the Fed chair. He was speaking to the House on Tuesday. Today, he's speaking to the Senate Banking Committee, and basically, again, basically gave all the same key points of what he discussed on Tuesday. So there's really nothing new, and basically, the stock market turned negative. So they're trying to find their footing with this new economy that we're moving into, because we're getting into more of a growing economy here, and so they're trying to adjust to it. And when the economy is growing, sometimes the Fed will kind of slow it down by pumping its brakes. And what that they do by pumping the brakes is basically raise interest rates. And now it's looking like they could raise 4 times this year, which would be a total 1% by year end with the interest rates. So the first one will probably be later this month in March here when they reconvene again, and that will probably be the first rate hike for this year. So just be prepared for that. going forward here. So let's see how this is affecting the bond market here. The bond market actually started off higher. We are down for the day, but we are about almost just barely above where we were yesterday, and we're kind of just resting on this floor of support. So yesterday this was a ceiling for us, and we stopped right at that ceiling. Today we're only up about like 2 basis points, so there's no price improvement for us today. Now East Coast, because he started off earlier, may have had a price improvement, but since West Coast here, we kind of a lot of times get our pricing out around 8-9 o'clock here, are coming in probably about the same as where we left off yesterday. So there's really no change in pricing today. And excuse me, here's the 10-year Treasury. 10-year Treasury is down a little bit, so we're down to about 2.86% right now. We were down a little bit further. We're approaching this 25-day moving average, which will give it some support here. So again, we are right about 2.86. So as we saw, we had this trend going upwards, but it looks like it might be breaking a little bit. Now, we may have a slight downturn here, which might give us a little reprieve of what we've experienced, but long term, I do see this kind of going up. So just be cautious here. Don't get this false security that you think that the rate's going to keep improving here, because over the long term, they're going to keep going up here. A lot of reasons for that. One, because last fall we announced the quantitative, all those times that the Fed was quantitative easing when we acquired all these treasuries of mortgage-backed securities. Now they're trying to unload some of that. So now they're kind of slowly releasing more of that back in the market. They're not reinvesting as much or not buying as much. And we really don't have a whole lot of appetite from other countries or corporations. Other countries, they have, with the dollar as weak, they don't want to, they would lose money in terms of with the exchange. So they're not really buying our yields, even though they're at pretty high levels right now. So anyways, there's not a lot of, again, a lot of demand for it right now. And this is another reason why we're going to start seeing rates continue to rise as we go forward here. So just be on the alert. Even though we're getting a slight improvement here, long term, you're going to start seeing this continue to climb here. All right. That pretty much wraps everything up. I hope you guys have a wonderful rest of your day. If you guys want to get more data, just come over to Twitter. You can find me at Mike Bjork on Twitter. Thanks so much for watching, and we'll look forward to see you guys on tomorrow. Bye-bye.